If you've ever wondered what actually happens when you stop waiting and just invest a real chunk of money into a dividend ETF, you're about to find out, because in this video, I'm walking through exactly what I get paid every single quarter after putting $25,000 into Schwab's SCHD. And more importantly, I'll show you why this ETF keeps showing up in serious investor portfolios, what makes its dividend payments so consistent, and how the compounding actually works when you reinvest those quarterly checks. By the end, you'll see a projection that shows what this same investment could grow into over 10, 20, and 30 years if you never add another dollar. But before we get there, make sure you hit that subscribe button so you don't miss the next breakdown. Now let's talk about why SCHD isn't just another dividend fund. Most dividend ETFs either chase high yield and sacrifice growth, or they focus on growth and barely pay anything. SCHD sits right in the middle, and that balance is what makes it different. It doesn't just buy any company that pays a dividend. It screens for quality. The fund tracks the Dow Jones U.S. Dividend 100 Index, which only includes companies that have paid dividends for at least 10 consecutive years. But it doesn't stop there. The index also filters for financial health. It looks at metrics like return on equity, cash flow to total debt, dividend yield, and 5-year dividend growth rate. That screening process weeds out dividend traps, companies that pay high yields but can't sustain them. What you're left with is a collection of about 100 companies that have strong balance sheets, consistent cash flow, and a proven track record of rewarding shareholders. And because SCHD rebalances quarterly, it drops companies that no longer meet those standards and replaces them with stronger ones. This isn't a static list. It's a living portfolio that adapts as business fundamentals change. The result is an ETF that has historically delivered both dividend income and price appreciation, which is exactly what long-term investors want. You get paid while you hold it, and the value of your investment grows over time. That's the foundation. Now let's talk about what that $25,000 actually pays. When you invest $25,000 into SCHD, the first question most people ask is simple: how much does it pay me? And the answer depends on the current dividend yield, which fluctuates based on the ETF's price and the dividends the underlying companies distribute. As of early 2025, SCHD's dividend yield hovers around 3.5%. That's not a fixed number. It changes as the share price moves and as the companies in the fund adjust their payouts. But for this example, let's use 3.5% as a reasonable baseline. If you take $25,000 and multiply it by a 3.5% yield, you get $875 per year in dividend income. SCHD pays quarterly, so you divide that $875 by 4. That gives you about $218.75 per quarter. Let me say that again. Every 3 months, you'd receive roughly $218 deposited directly into your brokerage account. That's not a guess. That's the math based on the yield and your investment size. Now, $218 per quarter might not sound life-changing at first, and honestly, it's not supposed to be. Not yet. But here's what most people overlook. That $218 isn't static. It grows. And the way it grows is what separates SCHD from bonds, savings accounts, and most other income-generating assets. SCHD's dividend has increased every single year since the fund launched in 2011. Not some years, every year. The companies inside the fund raise their dividends, and those increases flow directly to you as the shareholder. Over the past 10 years, SCHD's dividend has grown at an average annual rate of about 11 to 12%. That means your quarterly payment doesn't stay at $218. It climbs. In year 2, if the dividend grows by 11%, your quarterly payment jumps to around $240. In year 3, it could be $260. By year 5, you might be collecting over $340 per quarter, even though you never added another dollar to your initial $25,000. And here's the part that really matters. If you reinvest those dividends instead of spending them, the compounding accelerates dramatically. Every dividend payment buys more shares. Those new shares generate their own dividends. And the cycle repeats every quarter. This is the engine that turns a modest quarterly payment into something much bigger over time. But to really understand the power of that engine, we need to look at what happens over the long term. So let's map out 3 scenarios. First, let's assume you take your $25,000, invest it into SCHD, and never reinvest the dividends. You just collect the cash every quarter and spend it or keep it in your account. With a 3.5% yield and 11% average annual dividend growth, your quarterly payments would look like this. Year 1, about $218 per quarter. Year 5, around $340 per quarter. Year 10, roughly $560 per quarter. Year 15, close to $920 per quarter. Year 20, about $1,515 per quarter. Year 25, around $2,490 per quarter. And by year 30, you'd be collecting approximately $4,100 every 3 months. That's over $16,000 per year in dividend income alone, all from a single $25,000 investment made 3 decades ago. And remember, in this scenario, you're not reinvesting. You're just letting the companies do what they do best, grow their dividends year after year. Now let's look at scenario 2. Same $25,000 starting investment, but this time you reinvest every dividend payment. Every quarter, those dividends automatically buy more shares. And those shares generate more dividends, which buy even more shares. This is where compounding really takes over. Let's assume SCHD delivers an average total return of about 11% per year. That includes both dividend income and share price appreciation. It's a reasonable estimate based on the fund's historical performance and the long-term returns of quality dividend stocks. With dividends reinvested, here's what your portfolio could grow into. After 10 years, your $25,000 could be worth around $71,000. After 20 years, it could grow to about $202,000, and after 30 years, you'd be looking at roughly $575,000. All from that single $25,000 you put in at the start. And here's the kicker. At that point, with a 3.5% yield on a $575,000 portfolio, you'd be generating over $20,000 per year in dividends. That's more than $5,000 every quarter. And because you spent 30 years reinvesting, the dividend growth rate on your cost basis would be astronomical. Your yield on cost, the dividend income relative to what you originally invested, would be well over 80%. That means every year, you'd collect an amount equal to 80% of your original $25,000, just in dividend income. Now let's talk about scenario 3. This is where most people actually live. You start with $25,000, reinvest dividends, and you also add a little bit every month. Let's say you add $200 per month. That's less than $50 per week. Not a massive amount, but enough to keep the momentum building. With that $200 monthly contribution, dividend reinvestment, and an 11% average annual return, the numbers get much more interesting. After 10 years, your portfolio could be worth around $130,000. After 20 years, you'd be sitting on roughly $550,000. And after 30 years, you could have over $1.8 million. And at that point, with a 3.5% yield, you'd be generating over $63,000 per year in dividends. That's more than $15,000 every quarter. That's the difference between starting plus staying consistent. The initial $25,000 gets the snowball rolling. The reinvested dividends keep it growing. And the monthly contributions make sure it never slows down. But here's the thing. None of this works if you don't understand what you own. And that's where we need to talk about what's actually inside SCHD. SCHD isn't a random collection of dividend payers. It's a curated portfolio of some of the strongest, most reliable companies in the U.S. market. As of early 2025, the fund holds about 100 stocks, but the top 10 make up a significant portion of the portfolio. You'll find names like Chevron, Merck, Pfizer, Coca-Cola, PepsiCo, Verizon, Cisco, Texas Instruments, AbbVie, and Home Depot. These aren't speculative bets. They're established businesses with decades of operating history, strong cash flow, and a commitment to returning capital to shareholders. The fund is heavily weighted toward sectors like consumer staples, healthcare, financials, energy, and industrials. These are the parts of the economy that tend to hold up well during downturns and generate consistent cash flow regardless of market conditions. People still buy groceries during recessions. They still need medicine. They still pay their phone bills. And companies in those sectors tend to have pricing power, which helps them maintain margins even when costs rise. That stability is what allows SCHD to keep paying and growing its dividend, even when the broader market gets choppy. But owning quality companies is only half the equation. The other half is understanding what risks come with the strategy. And yes, there are risks. First, SCHD is 100% U.S. equities. It has no international exposure. That means if U.S. markets underperform relative to the rest of the world, SCHD will too. Second, the fund is concentrated in value-oriented, dividend-paying stocks. That means it won't capture the explosive growth of high-flying tech stocks or speculative sectors. If you're looking for the next company to 10x in 5 years, SCHD isn't built for that. Third, dividends are not guaranteed. Companies can cut or suspend dividends during tough times. And while SCHD's screening process reduces that risk, it doesn't eliminate it. We saw dividend cuts across the board in 2020, and even high-quality companies had to make tough decisions. Fourth, SCHD is sensitive to interest rate changes. When rates rise, dividend stocks often underperform because bonds and savings accounts start offering competitive yields without the volatility. And finally, there's sequence of returns risk. If you invest a lump sum right before a major market downturn, it can take years to recover, even with dividends reinvested. That's just the reality of equity investing. But here's the counterpoint to all of that. Over the long term, quality dividend growth strategies have historically outperformed most other income-focused approaches. They've beaten high-yield funds that chase unsustainable payouts. They've beaten bond-heavy portfolios that can't keep up with inflation. And they've even kept pace with or beaten total market index funds in many periods, especially when dividends are reinvested. The key is time. SCHD isn't a get-rich-quick play. It's a get-wealthy-slowly strategy. And the longer your time horizon, the more those quarterly payments and dividend increases compound into something truly significant. So let's bring this back to the original question. What does $25,000 in SCHD actually pay you every quarter? Right now, it pays roughly $218. But that number grows every year. And if you reinvest those payments, the growth accelerates. Within 10 years, your quarterly income could more than double. Within 20 years, it could be 10 times higher. And within 30 years, it could fund a comfortable retirement all by itself. Now let's talk about the mechanics. How do you actually receive those dividend payments? If you own SCHD in a brokerage account, dividends are typically paid in cash and deposited directly into your account. Most brokerages allow you to set up automatic dividend reinvestment through a DRIP or dividend reinvestment plan. When you enable DRIP, every dividend payment automatically buys more shares of SCHD, including fractional shares. You don't have to do anything. It happens in the background. And there's no commission or fee for reinvesting dividends through most major brokerages. This is the easiest way to ensure you're capturing the full compounding effect. If you don't enable DRIP, the dividends just sit in your account as cash. You can spend them, invest them elsewhere, or manually buy more shares. But manually reinvesting introduces friction. You have to remember to do it. You have to place the order. And if the cash just sits there, you're losing days or weeks of potential growth. For long-term investors, enabling DRIP is almost always the better move. Now let's talk taxes, because dividends are taxable, and how you hold SCHD matters. If you own SCHD in a taxable brokerage account, you'll owe taxes on the dividends every year, even if you reinvest them. Most of SCHD's dividends are classified as qualified dividends, which means they're taxed at the lower long-term capital gains rate, usually 0%, 15%, or 20%, depending on your income. That's better than ordinary income tax rates, but it's still a tax. And if you're reinvesting dividends, you're paying taxes on money you never actually spent. That's the trade-off of holding dividend funds in taxable accounts. If you own SCHD in a tax-advantaged account like a Roth IRA or traditional IRA, dividends grow tax-free or tax-deferred. In a Roth IRA, you pay no taxes on dividends or capital gains, ever. In a traditional IRA, you defer taxes until you withdraw the money in retirement. For long-term buy-and-hold investors, holding SCHD in a Roth IRA is one of the most powerful strategies available. You get decades of compounding without the IRS taking a cut every quarter. And when you retire, every dollar you pull out is completely tax-free. That makes a massive difference over 20 or 30 years. So if you're deciding where to hold SCHD, prioritize tax-advantaged accounts first. Use your taxable account only after you've maxed out your IRA and 401k contributions. Now let's address a common question. Is SCHD better than VOO or VTI? This is one of the most debated topics in the investing community, and the answer depends on what you're trying to accomplish. VOO and VTI are total market or S&P 500 index funds. They offer broad diversification, low fees, and exposure to the entire market, including growth stocks. SCHD is more focused. It only holds dividend growth stocks, and it's heavily weighted toward value and income. Historically, VOO and VTI have delivered slightly higher total returns in bull markets, especially during periods when growth stocks dominate. But SCHD has outperformed during certain periods, particularly when value stocks are in favor and when dividend growth accelerates. SCHD also offers higher current income, which matters if you're retired or close to retirement and need cash flow. VOO and VTI have lower yields, usually around 1.5%, so they're better suited for investors focused purely on growth. There's no universally correct answer. Many investors hold both. They use VOO or VTI as their core holding for broad market exposure and use SCHD as a satellite position for income and dividend growth. That's a balanced approach that captures the best of both strategies. But if you had to choose just one, ask yourself this: do you need income now, or are you focused purely on growth? If you need income or want exposure to quality dividend growers, SCHD makes sense. If you're decades away from retirement and just want to maximize total return, VOO or VTI might be the better fit. Now let's talk about dollar cost averaging versus lump sum investing, because this matters when you're putting $25,000 into any investment. A lump sum means you invest the full $25,000 all at once. Dollar cost averaging means you spread that $25,000 over several months, investing a portion at regular intervals. Statistically, lump sum investing wins more often. The market goes up more than it goes down, so getting your money in sooner usually results in higher returns. But dollar cost averaging reduces the emotional risk. If you invest $25,000 all at once and the market drops 20% the next month, it's painful. You'll question the decision. You might panic and sell. If you invest $2,500 per month over 10 months and the market drops, you're still buying at lower prices. Psychologically, that's easier to handle. So while lump sum investing is statistically superior, dollar cost averaging is emotionally superior. And in investing, emotions often matter more than statistics. If spreading out your investment helps you stay consistent and avoid panic, it's worth the slight statistical trade-off. Now let's look at SCHD's historical performance, because past results give context even though they don't guarantee future returns. Since its inception in 2011, SCHD has delivered an average annual return of around 13 to 14%, including dividends. That's slightly higher than the S&P 500 over the same period, though the comparison depends on the exact time frame you measure. SCHD outperformed during 2022, a year when growth stocks got hammered and dividend payers held up better. It also did well during the 2015 to 2016 period when value stocks were in favor, but it lagged during the 2017 to 2020 tech-driven bull run when growth stocks dominated. The point is, SCHD isn't designed to beat the market every single year. It's designed to deliver consistent income, steady dividend growth, and reasonable price appreciation over the long term. And it's done exactly that. The fund has never cut its dividend. It's raised it every single year. And it's delivered competitive total returns with less volatility than pure growth funds. That track record is why so many investors trust it as a core holding. But past performance is just one piece of the puzzle. Let's talk about what could go wrong. What are the scenarios where SCHD underperforms or disappoints? First, a prolonged period of low interest rates and surging growth stocks. If tech and speculative sectors dominate for another decade, SCHD will likely lag. Second, widespread dividend cuts. If a recession forces many of SCHD's holdings to suspend or reduce dividends, the fund's income appeal weakens. Third, poor sector rotation. If energy, financials, and industrials underperform for years, SCHD will struggle since it's heavily weighted in those areas. Fourth, inflation that erodes purchasing power faster than dividends grow. If inflation runs hot and dividend growth can't keep up, your real income declines. And fifth, behavioral mistakes. If you panic and sell during a downturn, you lock in losses and miss the recovery. None of these scenarios are impossible, but they're also not guaranteed. And the beauty of a long-term strategy is that you don't need perfection. You just need consistency. Even if SCHD delivers 9% annual returns instead of 13%, it still compounds into serious wealth over 20 or 30 years. Now let's talk about building around SCHD. What other investments pair well with it? If SCHD is your core dividend holding, consider adding broad market exposure with VOO or VTI for growth balance. Add international diversification with VXUS or VTIX to capture global opportunities. Consider a small allocation to bonds or bond funds like B&D for stability, especially as you approach retirement. And if you want more growth, add a small position in QQQ or VGT for tech exposure. The goal isn't to own everything. It's to build a portfolio that balances income, growth, stability, and diversification. SCHD covers the income and quality dividend growth piece. The other funds fill in the gaps. Together, they create a portfolio that can weather different market environments and keep compounding through volatility. Now let's bring this full circle. You put $25,000 into SCHD. Every quarter, you collect around $218 in dividends. That dividend grows by roughly 11% per year. If you reinvest those payments, your portfolio could grow to over $575,000 in 30 years. If you add $200 per month on top of that, you could reach $1.8 million. And at that point, you'd be generating over $15,000 per quarter in dividend income. That's the power of starting with a real investment, staying consistent, and letting dividends compound. It's not flashy, it's not exciting, but it works. And the reason it works is because you're not chasing trends or timing the market. You're owning quality businesses that pay you to hold them. You're reinvesting those payments to buy more ownership. And you're giving time the chance to do what it does best: multiply small actions into large outcomes. If you want to see how a different portfolio strategy compares, or how other dividend ETFs stack up against SCHD, check out the video on your screen. It breaks down another powerful approach that could fit your goals even better. And here's the part most people don't think about until it's too late. The biggest risk to a strategy like this isn't market crashes. It's impatience. It's jumping from fund to fund. It's chasing whatever just had a great year. SCHD works because it's boring in the best possible way. It does the same thing quarter after quarter. It collects cash from profitable companies. It raises those payouts over time. And it quietly compounds in the background while everyone else is reacting to headlines. The investors who get the best results with SCHD aren't the ones who check it every day. They're the ones who set it up, turn on dividend reinvestment, and then let years pass. Because the real magic doesn't show up in year 1 or year 3. It shows up in year 10, when your quarterly income is noticeably higher than when you started. It shows up in year 20, when the dividends alone could cover real bills. And it shows up in year 30, when that original $25,000 looks almost unrecognizable compared to what it's become. This is how regular people quietly build financial independence. Not by hitting home runs, but by stacking singles for decades. By owning assets that pay them to wait. By letting time and compounding do the heavy lifting instead of trying to outsmart the market. If you're serious about building long-term income and you want more breakdowns like this, hit the subscribe button so you don't miss the next deep dive. Drop a comment with how much you're investing and how long your time horizon is, and I'll show you what that could realistically turn into.